Gold price surges on weak U.S. jobs data. Trump's tariff impact explained. Imagine a world where the value of gold skyrockets overnight, leaving investors scrambling to make sense of the sudden shift. This isn't a fictional scenario, but a reality that unfolded recently as gold prices surged to their highest level in 2 months. But what triggered this dramatic turn of events? The answer lies in the latest U.S. jobs report, which revealed a sharper-than-expected slowdown in job growth over the past 3 months, coupled with a rise in the unemployment rate to 4.2%. This unexpected twist has sparked a flurry of activity in the markets, with gold prices rising as investors bet on the Federal Reserve lowering interest rates as soon as next month. But here's where it gets interesting. The yield on 2-year U.S. Treasuries took a tumble, which is a significant indicator of the market's expectations. So, what does this mean for gold? In simple terms, lower yields and borrowing costs create a perfect storm for gold to shine, as it doesn't pay interest. This is because when interest rates are low, investors are more likely to turn to gold as a safe haven asset, driving up its value. And this is the part most people miss: the intricate relationship between gold, interest rates, and the overall health of the economy. As the markets continue to monitor the situation, one thing is clear. The recent gains in gold are a testament to its enduring appeal as a hedge against uncertainty. But controversy surrounds the Federal Reserve's potential decision to lower interest rates. Some argue that it's a necessary move to boost the economy, while others claim it's a recipe for disaster. So we have to ask, do you think the Federal Reserve should lower interest rates? And what impact do you think it will have on the gold market? Share your thoughts in the comments below. As we navigate this complex landscape, one thing is certain: the value of gold will continue to be shaped by the evolving economic landscape, and investors would do well to stay informed. The question on everyone's mind is, what's next for gold? Will it continue to rise, or will the tide turn? Only time will tell, but one thing is clear: the current situation is a stark reminder of the importance of staying vigilant in the ever-changing world of finance. Gold prices drop as Fed holds rates steady. Market update. Gold prices took a hit today as the Federal Reserve held its key interest rates steady, leaving investors in a holding pattern ahead of critical policy updates. But here's where it gets tricky. Even though the central bank resisted calls for rate cuts, the market's reaction was anything but straightforward. Let's break down what's really at stake and why this moment could define the next chapter for gold and the broader economy. The U.S. Central Bank's decision to keep interest rates unchanged at 4.25% to 4.5% came despite mounting pressure from President Donald Trump, who has repeatedly pushed for rate reductions. While gold initially dipped by 0.7% to $3,301.82 per ounce, the move highlights a fascinating dynamic. Gold typically thrives in low-rate environments, yet here it's underperforming. Why? Stronger than expected economic data, including a 3% GDP growth rate, beating forecasts, and a surge in private sector jobs, has investors questioning whether rate cuts are even on the table for the rest of the year. Nitesh Shah, a commodities strategist at WisdomTree, put it plainly: the louder the administration complains about policy, the more gold tends to gain. But today, the economy's strength drowned out that noise. And this is the part most people miss. The Fed isn't just reacting to the present. It's waiting to see how recent tariffs shake out. Federal Reserve Chair Jerome Powell made this clear during his press conference, stating no decisions had been finalized for September. This wait-and-see approach creates uncertainty, which usually boosts gold's appeal. Yet the dollar's recent pullback and Treasury yields decline briefly propped up gold prices earlier in the day, only for them to retreat. Could this be a sign of indecision in the market, or a hint that gold's rally is far from over? Meanwhile, other metals followed suit. silver fell 1.6% to $37.59 per ounce. Platinum dropped 3.3%, and palladium slipped 2.9%. These declines underscore a broader trend. When economic data looks solid, non-essential investments like precious metals often take a back seat. On the geopolitical front, the U.S. and China extended their 90-day tariff truce after talks in Stockholm, adding another layer of complexity to market sentiment. But how much does this really matter compared to domestic economic signals? Shah argues that while trade tensions can sway gold prices, today's focus was squarely on the Fed's cautious stance. So what's next? With the Fed's full policy statement due later today, traders will be watching for clues about the timeline for rate cuts. If the central bank gold price hits one-week high, U.S. payrolls data fuels Fed rate cut hopes. Market impact. Gold surges nearly 2% as U.S. payrolls data fuels rate cut hopes. In a bustling showroom in Ahmedabad, India, a goldsmith meticulously weighs gold jewelry, a scene captured on July 31, 2025. This image, courtesy of Reuters' Amit Dave, encapsulates the enduring allure of gold. But here's where it gets controversial. The price of gold isn't just about its shine. It's deeply tied to economic indicators and geopolitical tensions. Key points to know. Also, markets are betting on 2 interest rate cuts by the end of 2025. President Trump has introduced new tariffs on Brazil, India, Canada, and Taiwan. Silver, platinum, and palladium are poised for weekly losses. On August 1st, gold prices soared almost 2%, reaching a one-week high. This surge came after U.S. payrolls data fell short of expectations, fueling hopes for a Federal Reserve rate cut and spurring demand for safe haven assets. Spot gold hit $3,347.66 per ounce, marking a 1.8% increase by 0:48 p.m. ET 1548 GMT, with bullion rising as much as 2% earlier in the day. For the week, gold was up by 0.4%. Sign up here to stay updated on the latest market trends.